Hello, Accounting One. This is Miss Allie, and I am logging into the Line Tap so that we can go in, and we're going to be going this time to 2-1. Okay, here's Launch Course. This is your book, the green book, Launch Course. Click on that. It will load the book, and it'll show you 4 different sections of the book. And today we're going to be going into the first section, Part 1. So I need you to click the down arrow there beside Part 1. And then we're going to Chapter 2. So I need you to click the down arrow of Chapter 2. This will open up 3 different sections of Chapter 2. And today we're doing the lesson 2-1, using T accounts. So I want you to click on the down arrow right underneath where it says Lesson 2-1, Accounting using T accounts. I want you to click on the down arrow where it says End of Lesson Review. This will open up terms, which is your vocabulary if you'd like to check on that. And we're going to go down here to working papers. And with the working papers, it opens up and it tells you we're going to be doing work together and on your own. I'm going to walk you through work together and then let you work yourself through on your own. All right. If you want to practice this again and again, right here, you click try again. It will clear out your scores from last time, and you can keep practicing it until you get hundreds. All right. So today we're doing work together. This is also on page 35 of your book in the textbook. All right. So it tells us for each T account, and you see this is a T, label the debit and credit side. Select increase on the increase side, select decrease on the decrease side, and identify the normal balance. Well, I want to remind you that the normal balance side is the increase side. All right, so I'm going to use my writing tablet here, and sorry that it's not, the handwriting isn't all that great, but I want you to notice that debits are always on the left and credit is always on the right. So you can go and fill those in, those first 2 lines for every one of them already with let me put this, let me do this better. So debit is always on the left, credit is always on the right. Now it says select the increase side and the decrease side. The normal balance is the increase side. It's one and the same. One and the same. And this is going to be the opposite. The opposite of the increase side. Okay. Now I want to show you one more thing. I'll make this up, or well, I learned this off of YouTube actually. DC Adler. This writing pad's not as easy as it looks to be. All right, DC Adler. DC is your debit credit. 100% debit is always on the left, credit is always on the right. Can't change it, will never change. They have to balance. But looking at this, I'm telling you the normal balance. So the normal balance for assets is a debit. It's always going to increase on the debit side. D is for drawing. That's when the owner takes money out of their business to use it for their personal life. There's no, that's not illegal because the owner owns all of it. And then this is expenses, like your phone expense, your electricity expense, because you have to pay for stuff to run your business. This is your liabilities. your equity, your owner's equity, or your capital account, and this is your revenue, also known as sales. Now, I want to remind you that accounts payable, all accounts payables are liabilities. You owe those to somebody else. You have to pay somebody else that. And then assets includes accounts receivable. That's when somebody owes you money. You're waiting to receive it. That's considered an asset. This tells me that assets, drawing, and expenses will always increase on the debit side. Liabilities, equity, owner's capital, revenue will always increase on the credit side. These are called credit accounts because they increase on the credit side. These are called debit accounts because they increase on the debit side. Always, always, always write it down. It'll always be that way. Now, in accounting, we don't have plus and minus signs. So when you need to decrease an account, it's on the opposite side. It's the opposite side of the normal balance. That means that if an asset decreases, I'm going to write that amount on the credit side. If a drawing decreases, I'm going to put it on the credit side. If an expense decreases, I'm going to put it on the credit side. If liabilities, when I pay those loans off, I'm going to record that on the debit side because they're going down. Equity, when the owner loses money or they take money out, whatever, when it's a negative, it's going to be on the debit side. Sales and revenue, when it decreases, it will also go on the debit side. Okay, so the opposite side is decreased. The opposite side of the normal balance. The normal balance is the side that increases. So I hope that makes sense. You can go back and listen to the video all you want to. Okay, so cash, this is always debit and this is always credit. Can't change that. Cash is an asset account. We own it and it has value. This tells me that it increases on the debit side. Increase, which means the other side decreases. And it wants to know the normal balance or which side increases. Debit. Now, this is what it's going to look like on every account that is an asset or a drawing or an expense. They're all going to look the same. All going to look the same. All right. So now I go down here to accounts receivable. It's still debit and then it's still credit. Accounts receivable, we own it and it has value. This is something somebody else owes you money. In this case, Sullivan Company owes you money. This is an asset. It increases on the debit side, it decreases on the opposite side. And the normal balance is where it increases. Over here, debit. Okay, supplies. I just know from the start, it's debit credit up here. Can't change that. Supplies, we own them and they have value. Think about the toilet paper about a year ago, how everybody was buying it up and hoarding it. It was a supply and it was very valuable. Supplies are assets. So all assets increase on the debit and decrease on the credit side, and the normal balance is always where it increases. Prepaid insurance. We know that debit's on the left, credit's on the right. Can't change that. Prepaid insurance, prepaid means that you pay it up front, you own the policy, and it covers you for the next month or 2 months, 3 months, however long. So this is something that you have purchased and it has value. It is an asset. All assets increase on the debit side, decrease on the credit side. And they all increase, normal balance, on the debit side. The next one says accounts payable Sawyer supplies. First of all, I know it's debit and it's credit. Those can't change. But this is an accounts payable. This means that we owe money to Sawyer Supplies. We took their supplies and we gave them an IOU that we would pay them later. And that makes it a payable. This is kind of like a loan. They loaned us this stuff until we pay them back. So we go over here and liabilities, when we owe somebody some money, when we owe them money, and it's an account payable. Account payable are liabilities. They increase on the credit side. They decrease on the opposite side. Your normal balance for payables, for liabilities, is right here, credit. Okay? Next one says accounts payable. Here's another accounts payable. Oh, we know we're going to do debit and credit. Another accounts payable. Well, it's another loan. We owe money to Oceanside Supplies. So it's done the same way as this one up here. It increases on the credit. It is a credit normal balance, and it decreases on the debit side. All accounts payable work the same way right here. And if it's an equity account, which is what we have next, the capital account, whenever you see the person's name, Parker Vogel, in capital, this means this is the owner, Parker Vogel, and the capital account is his equity account or her equity account. I don't know if that Parker is a girl or a boy. Well, we know for sure debits go on the left, credits go on the right. And this tells me over here that equity is a credit account. A credit account increases on the credit side. It has a credit normal balance, which means it decreases on the other side. Okay? Now, I'm going to erase some of this stuff that I wrote on here. Doesn't make sense anymore. Okay? And hopefully you have the same answers that I do. Now I'm going to go down here and check answers. There's a box at the bottom that says check answer. And so I do that, and look, right up here at the top, it tells me I got 7 out of 7 points. That's fantastic. That's a 100. So they gave you a point for doing the cash one right, a point for doing the accounts receivable correctly, the supplies correctly, the prepaid insurance, the accounts payables are correct, capital's correct. So we got 7 out of 7 points. Now, it's your turn. So you can go back and watch the video all you want. Click Save and Continue down at the bottom. Save and Continue. Now it goes to the On Your Own assignment, which is on the same page, page 35. This one is done exactly like what I just did. And but this is for a different company. But you're going to do the same thing. You're going to label the debits and the credits. Do that first. Go through all of them, labeled debits and credits. And then you got to figure out what type of account is it? Is it an asset where it's going to increase on the debit side? Is it a liability where it's going to increase on the credit side? Or is it an equity, which is the owner's capital, that's going to increase on the credit side? So you put the increase and decrease where it's supposed to be, and then you put in the normal balance side. When you get to the bottom, check your answers. Okay? Now, do this, practice, practice, practice. It'll make the rest of the semester so much easier once we get this all down. All right? Now, I'm going to check out for now. I'm going to tell you to stay well and stay safe, and I'll see you back here soon. Bye.